Welcome back to LAUTECH Open Distance Learning Lecture Series, ACT113, Elements of Banking, Study Section 2, Theories of Banking. In the previous study section, we discussed about the origin of banking, the evolution of banking in Nigeria, and also explained the growth and development of banking in Nigeria. Now we'll discuss the theory behind banking. So these theories for banking sector. These theories of banking sector were being propounded by scholars who bears in mind the bank's unique type of business, which sought to provide solutions on how the unique business can survive. And learning outcome for this study section. At the end of this study section, you should be able to state and explain the theories of banking. You should be able to differentiate between the theories of banking and also to identify and explain the strengths and weaknesses of banking theories. Let's take them one after the other. Theories of banking. The following are the real theories of banking. We have the rule-based doctrine, we have the shift ability theory, we have the anticipated income theory, and the liabilities management theory. Let's discuss it. The real business doctrine, that is the RBD, or the commercial loan theory, states that a commercial bank should advance only short-term self-liquidating loans to business firms. And the theory states that when commercial banks make only short-term self-liquidating productive loans, the central bank in turn should only lend to banks on the security of such short-term loan. And also the shift ability theory it is postulated that market liquidity could be provided if a percentage of safe deposits were used to acquire assets that are sellable in the secondary market. While the anticipated income theory can be as simple as the accounts receivable or more complex as franco payments and even prepaid expenses you will gain in the future. And some of the pros for anticipated income theory includes ability of banks to make long-term loans, increased velocity of money within an economy, or tightening inflation. While the liability management theory, this theory was developed in 1960s, and according to this theory, there is no need for banks to grant self-liquidating loans and keep liquid assets because they can borrow reserve money in the money market in case of need. And a bank can acquire reserves by creating additional liabilities against itself from different sources. So, difference between the theories of banking. The difference between the rule-based doctrine and the shift ability theory is that the rule-based doctrine or the commercial loan theory states that a commercial bank should advance only short-term self-liquidating productive loans to business firms, while the shift ability theory of bank liquidity was propounded by H.G. Morton, who asserted that if the commercial banks maintain a substantial amount of assets that can be shifted onto the other banks for cash without material loss in case of necessity, then there is no need to rely on maturities. Let's now talk about the strengths and weaknesses of the banking theories. The merits of rule-based doctrine for short-term self-liquidating productive loans are: first, they possess they possess liquidity. That is why they liquidate themselves automatically. And secondly, since they mature in short run and are of productive purposes, so there is no risk of their running to bad debts. And also the third one, they are being productive. That is, the loans enhance income for the banks. And the following are the demerits or the disadvantages of the real bills doctrine. First, if a bank refuses to grant a fresh loan till the old loan is being repaid, so the disappointed borrower will have to reduce production, which will adversely affect his business activities. So if all the banks follow the same rule, this may lead to reduction in money supply and price in the community. So this may in turn make it impossible for existing debtors to repay their loans in time. And also, if the doctrine assumes the loans are self-liquidating under normal economic conditions, there will be depression for the production and trade will suffer, and the debtor will not be able to repay the debt at maturity date. And the third one is the doctrine neglects the fact that the liquidity of a bank depends on the sole ability of its liquid assets and not a real trade bills. If a bank possesses a variety of assets like bills and security, which can be readily in the money and capital markets, so it can ensure safety, liquidity and profitability, then the bank need not only not to rely on maturity in time of troubles. And the fourth one is the basic defeat of the theory is that no loan is in itself automatically self-liquidating, and a loan to a retailer to purchase investor is not self-liquidating if the inventories are not sold to the consumers and remain with the retailer. Thus, a loan to be successful involve a third party, that is the consumers in that case, beside the lender and the borrower. And its theory is based on the needs of trade, which is no longer accepted as an adequate criterion for regulating this type of bank credit. And if bank credit and money supply fluctuates on the basis of the needs of trade, the central bank cannot prevent either recession or inflation. And the demerits of shift ability theory. Shift ability of asset does not provide liquidity to the banking system. It entirely depends upon the economic circumstances. And secondly, the shift ability theory ignores the fact that in the times of acute depression, the shares and the debentures cannot be shifted onto others by the banks. And the merits of the anticipated income theory. This theory is superior to the real biz doctrine and the shifted ability theory because it fulfills the three objectives of liquidity, safety, and profitability. Liquidity is assured to the bank when the borrower saves and repays the loan regularly in installments, and it satisfies the safety principle because the bank grants a loan not only on the basis of the good security, but also on the ability of the borrower to repay that loan. Thank you for listening. I hope you have a wonderful tour.